So, hi everyone, welcome back to the first lecture in the series of Quant Finance, that is Quant 101. So, welcome everyone, and in this series, going to slowly build a complete foundational understanding of Quant Finance, and we'll do it slowly, clearly, and a lot of real world examples. Now, before we actually go into the formulas and pricing models, it is important that we understand what this field actually looks like. Quant finance is a space where mathematics, statistics, programming, economics, and finance they come together and help us actually make a sense of financial markets. Each one of these elements is equally very important. I want you to imagine financial markets like a massive, constant moving ocean. Prices rise and fall like waves, sometimes calm, sometimes very chaotic. A quant's job is to study these waves and build models that can actually predict, understand, and even take advantage of these movements. Throughout this playlist, we'll be talking about first and foremost derivatives. Things like futures, options, forwards, swaps. They may sound like complicated financial products but by the end of this series, you'll look at them as the same way that you look at everyday tools. Simple, intuitive, and very powerful. Derivatives are the heart of modern finance. Whenever you hear things about hedge funds making billions or large banks managing global risks, derivatives are almost always involved in this. And why exactly is that? Because derivatives allow us to hedge risks, speculate on price movements, and structure complex financial solutions. This session is meant to open the door to all of this. Think of it as starting point of a long journey, one that will eventually lead us to things like option Greeks, Black-Scholes, stochastic calculus, and many other advanced topics that I had already briefed about in my first video. But every journey starts with the understanding of the basic building blocks, and that's exactly what we'll do here. So just sit back, relax, and enjoy the process of discovering how the world of financial mathematics actually works. Now, what exactly is quant finance? Quantitative finance is often very highly misunderstood as a technical world dominated only by equations, algorithms, and complex charts. While that is partly true, the actual purpose of quant finance is beautifully simple. It helps us understand uncertainty. Anytime there is money involved, uncertainty definitely exists. Stock markets move unpredictably, interest rates definitely fluctuate, currencies rise and fall, and risks constantly evolve. Quants use mathematics to bring order to this chaos. Think of it like weather forecasting. A meteorologist doesn't know exactly when or where it will rain, but they can predict probabilities based on various patterns. Similarly, in finance, we cannot exactly predict with absolute certainty whether a stock will rise, whether a stock will go down tomorrow. But with quant finance tools like probability distributions, volatility models, stochastic process, we can estimate how uncertain or certain the movement is, how risky an investment is, or what price a financial product should logically have. For example, imagine a company that wants to raise money by issuing an option to investors. How do they decide what the option is worth? Or how do they consider a bank managing thousands of loans? How does it estimate the chance that borrowers might default? Or think about a trading firm trying to identify small price inefficiencies that last only about few milliseconds. All of these require quantitative methods. So when we study quant finance, we are not just learning formulas. We are actually learning how to think about uncertainty. This series will actually expose you to the core building blocks of that thinking. By the time you complete this, you will be able to understand financial risk, derivative pricing, hedging techniques, and much more of that with almost complete clarity. So let's move on to derivatives intro. So before we explore advanced models used by quants, we have to master derivatives because derivatives are the language of modern finance. A derivative is simply a financial instrument that derive its value from something else. I'll give you a very easy example. Imagine a sugarcane juice stall. The price of the sugarcane juice completely depends on the price of the sugarcane. If the sugarcane becomes expensive, the juice will also become expensive. If sugarcane becomes cheap, the juice will also become cheap. That makes sense, right? So that dependency is what we call as the deriving value. In finance, derivatives work the same way. Their value depends on the price of an underlying asset. That could be a stock, a currency, a commodity, or even an interest rate. So in this session, we are going to focus on four complete type of derivatives, that is forwards, futures, options, and swaps. But derivatives don't trade all in the same way. Some trade on exchanges, formal regulated marketplace where everything is very standardized. Other trade privately between two parties in over-the-counter markets, that is also called OTC. The difference between the two will matter a lot as we go forward because it affects transparency, risk, and the flexibility of each contract. This is the session where we lay out the entire roadmap of what's ahead. Once you understand how derivatives work and why they exist, you'll see how quant build models to price them and manage the risk that they create. Now let's move on to understanding the derivatives. The easiest way to understand derivatives is to think in terms of everyday life. Let's take the example of, again, I'm just going back to juices, but yeah, that's the most easiest way to explain anything. So let's take the example of orange juice. If orange suddenly becomes very expensive due to poor harvest, the price of orange juice will definitely go up. And if oranges become cheap due to surplus supply, orange juice becomes cheaper. That makes, again, it makes sense. This means that orange juice does not have an independent value. It depends entirely on how oranges are priced. This is the same logic behind derivatives. A derivative is a contract whose value depends on the price of an underlying asset. Like I had already mentioned, it might be a stock, a commodity, or even a currency. Without the underlying asset, the derivative is meaningless. For example, an option on Reliance stock has no standalone value. Its value comes completely from the price of the Reliance shares. If the stock goes up, the option may become valuable. If the stock goes down, the option may become totally worthless. Derivatives play a huge role in financial markets because they allow traders, companies, investors to manage risk, speculate on price movements, or achieve exposure to assets without actually owning them. For example, airlines often use derivatives to lock in fuel prices months in advance. That way, even if the oil prices suddenly spike, the airline's cost remains stable. So, the key takeaway here is very, very simple. Derivatives are tools that react to the movement of something else. They depend entirely on their underlying, they do not have any direction of their own. It entirely depends on what the underlying asset is actually doing, going up or going down. So, as we move forward, this dependency will help you understand how pricing models, hedging strategies, and risk management techniques actually work. So, this was all about the intro to derivatives. And thank you for listening. And if you have any comments or any doubts, you can please put it on the comment section. Thanks a lot.